Today I'm going to talk to you about how Antipodes is taking that pragmatic value approach to investing in global small and mid-cap companies. My name's James Rodda. I'm the lead portfolio manager of the Global Opportunities Fund. It's a fund that we've been running now for 2.5 years, and we're again excited to present at this forum for the second time. I want to share 3 key takeaways today with you that hopefully I can give you some insight on by the end of the session. The first is the opportunity in global small and mid caps, which plenty of people have spoken about today, but it is certainly an exciting time to be considering that for your client portfolios. Secondly, talk about how we go about it, that industry-led research approach, and why it's critically important when investing in small and mid caps and how it fits within our broader business. And lastly, how we've done so far implementing that strategy. But first, I think it's important that you know something about the person that's managing your money. So I'd like to start by introducing myself. For those of you who haven't met me before, my journey at Antipodes started 10 years ago when we became the business as a founding partner, and I'm also a co-lead manager on our large cap strategies. But my investing journey, it didn't start there. It started somewhere around the time this photo was taken. I was in grade 4 and 9 years old. So this is when I bought my first shares. I'd saved up $500, and Mum, who was a nurse, and Nana, who was a garment maker, didn't know a lot about stocks and got me to call the radio expert. So after that call with the radio expert, I ended up with 100 shares in Boral, 100 shares in Coles Myer. Thinking back, obviously, I'm not sure if that advice is general in nature, but it's how it turned out. Anyway, that investment ignited a flame for me. Pretty much immediately, I'd read the business newspaper every day. I read One Up on Wall Street by Peter Lynch in grade 6, and it's really, what I'm passionate about today. A stock nerd, spending most of my time, not all my time, but the vast majority of my time managing the portfolios, and I really enjoy doing it. So, back to the 3 key points. Why global SMID caps? Why are they attractive right now? So, as you can see here, in 2018. Global large caps, this is the top 25%, so think about it as the high end of your S&P 500 ETF or your NASDAQ ETF. Around 2018, their multiples passed over small and mid-cap stocks. So that small cap premium, which is empirically researched for decades and decades, disappeared. Fast forward to today, and we're roughly at double the multiple for these large mega cap companies that we're at for a small and mid-cap index. So why is this the case? Is it regional composition? Both groups have roughly the same allocation to the US in terms of large cap indices versus small cap indices, slightly more to the US, but it's an immaterial difference. Is it growth? Here's a 10-year growth differentials, 1.5%, as you can see. So it's 7 years back, 3 years forward, 7.3% versus 5.8%. So again, yes, it's growth, but the growth differential is not as big as the narrative that you will read in papers each day. So when we think about this, we think about it, and you're thinking about investing your client's money. The other thing that you'll notice is that small mid-cap line is basically in line with long-term averages. So at 15.8 times, that's a 6% starting earnings yield. If you can pick up 4 or 5 points of growth, you can get to double-digit returns, and returns look set to be at the long-term average. In terms of thinking about the gap, how can the gap close? If you take my view of the world, you would probably agree that gap is significantly, or is way too large to close via earnings differentials alone. So it has to close via some sort of mean reversion, either one going up or one multiple going down. And therefore, if you believe that, you do believe that it's a good time to allocate capital to small mid-cap companies because they will outperform large-cap companies. In terms of opportunities, I think the index is vast. It's been mentioned before, so significant opportunities for idiosyncratic alpha based on stock selection. You can also see here, this is our measure of credible coverage of stocks. There's a lot less coverage of global small and mid-cap companies. What I would highlight to you though is that's at the analyst level. If we take that back to the industry level, which is critical to our process, I can easily find from a broker a 200-page research note on electric vehicles or even the batteries within electric vehicles or AI or climate change or whatever it may be that's really focused on the top end of town. What I can't find is deep industry research on Florida hurricane insurance or something like that we're actually invested in. So at the industry level, it's extremely time consuming to produce that research, but it is what we do at Antipodes. We look at the competitors, suppliers, the competitive environment, think about where value is created. And it's very unique, and our team has capabilities to do that, which I'll come back to now, talking about our industry research led approach to uncovering opportunities in the stock market. So how do we go about that? So firstly, I think it's, what do you focus on? And it's change, and it's misunderstood change, not just change. A lot of change is price. So we need to pay great respect to the prices that we're paying, but we do need to focus on change, and change that's misunderstood. So it goes without saying that cyclical change or structural change may present value traps for value investors, but it goes the other way. So think about things where change is misunderstood. It might be in 2020 during COVID. Everyone thought travel wasn't going to continue. We were never going to jump on a plane again. That was a structural change, according to most people. Turns out it was a cyclical change driven by that health event. If we think about something that most people in the room would use, social media, big structural change that was recognised 10 years ago. People using Facebook every day, Instagram, scrolling along, 4 pieces of content, an ad, 4 pieces of content, then an ad. But the change that wasn't recognised was that the data attached to that ad was going to become incredibly valuable and incredibly targeted, such that those ad prices would go up significantly. We don't actually spend more time on Facebook than we used to, but the company is making significantly more money through advances in that targeting technology. So bringing it to life at a team level, we're the 30-strong investment team. It's a large team. Since we've started the business 10 years ago, we've covered almost all industries with deep industry research. And so if I think about what that means at a high level, it means investing in a small company, we have a really good idea about what Amazon's doing if we're buying a retailer. Critical. Should you be buying a retailer if you're not focused on what Amazon's doing? I would argue that you shouldn't. We have a great understanding of Microsoft. Again, we're here to talk about small caps, but should you be buying a small software company if the company that can crush you, and often does come along and crush small companies, is not on your radar and are not an integral focus of your research process? Again, I would argue you shouldn't be investing in that sector. In terms of the way we're set up, this is an example of several industries that we cover in a lot of depth. We have deep industry expertise at the individual level. So Nick, who leads our healthcare team, for example, is a molecular biologist scientist with a PhD, worked in markets for 10 years, and we have deep industry sort of expertise across the business. But that research at the industry level that starts high level allows us to broaden out and understand the niche areas that we want to be focused on. And that's resulted in many of the companies here returning 100% for our investors since inception. If I'm going to talk about an example, I'll use the TV media example there. So you can see we own Roku and Magnite. Roku is an operating system for televisions, and Magnite is the company that supplies the ad technology for programmatic TV ads for 29 of the top 30 streaming services. So, industry analysis. Over half TV time in the US is spent on streaming, and it's going up. It'll probably end up being 100%. But less than 10% of advertising revenues are linked to streaming. Huge split. Why is that happening? Well, 12 months ago, Netflix didn't have an ad-supported product, Disney didn't have an ad-supported product, and neither did Amazon. Turn on your TV now, Netflix wants to serve you ads, Amazon wants to serve you ads, and Disney wants to serve you ads. They still want the subscription revenue, but the fast-growing part of this sector and this business is going to be the advertising side. Then we sort of think about, well, how big is the opportunity? That streaming advertising revenue is around 3% of digital ad spend, so largely Google and Facebook. If we compare that to time spent, there's still 1.5 times more time spent in the average household by the average human watching TV than watching social media. So the upside there is extremely large. That's top down. Let's go bottom up. An ad on Facebook, again, 4 pieces of content, 1 ad, 4 pieces of content, then an ad, sometimes or usually is only seen for about 1 second. It's a very quick ad, it's a very small format ad, it's well targeted, but it's not a valuable ad in terms of form factor. A TV ad is a 30-second ad, so much more valuable if you can get someone you want to look at, someone to look at it who is in your target market. However, 80% of TV spend has been the top 300 companies. So who can afford to do that? You have to hit everyone with a TV ad. It's not personalised. So you end up with toothpaste, automakers, just things that apply to everyone. There's no targeting. And the change that's coming on that side is personalised TV ads. So when you log into your TV now, they know where you live, they know your credit card, they know if you like watching, home decor shows or cooking shows or car shows or sports shows or whatever, and they can build their own profile about you. Yet serving the ads is extremely immature, and that's where the opportunity is. So if we take it down to the stock level, how does Roku fit into that? As I mentioned, Roku is the leading operating system in the US. It's like over 50% of households. It's the dominant operating system. So when we think about operating systems, if I go back to the desktop, it was Microsoft and Linux, a duopoly. On the mobile phone, it's a duopoly between Apple and Android, owned by Google. And this company has more market share than the other players combined. So at the moment, the other players might be LG and Samsung with their native systems, but also Apple and Amazon and Google. This company is going to be one of the two players to survive, and it's probably going to be a duopoly as industry structure. How do they make money? 2 ways. So a cut of your streaming subscription revenue. Again, that's quite mature, and most people who signed up to Netflix actually haven't signed up via these operating systems. Incrementally, more people are. So it's a small part of the revenue line. But they take a cut of the second way they make money is they take a cut of ad revenue. So when you're watching your Netflix and you get an ad in the future, or watching Amazon and you get a TV ad, they're taking 15%. This means the product is sticky, has a really high NPS score, and it just sounds like a fantastic opportunity. Now frame that as an investment case. Stock's trading today on current revenues, 15 times normalised profit, with huge growth to come in terms of the ad pricing and the volume of TV ads that will be served via streaming. There we go. Okay, so how does this fit into the portfolio? So we're taking a pragmatic approach to value. We're very risk management focused. So we're talking about a 60 stock portfolio, which we think makes sense in a volatile small and mid cap market. And we're investing across the growth spectrum. So we're seeking mispriced opportunities relative to the growth profile and relative to the quality of the company. So there's a company like Roku I just mentioned that's a fast grower. The largest positions in our fund are more stable businesses, more mature businesses on around 5 times earnings. And I think it's paying the right multiple relative to expectations is really important. So as we sit here right now, the US has just whacked China with all these tariffs, but the Hang Seng is flat and US futures are down 4%, right? So it's not necessarily about the impact, it's about what's priced in, and we're very downside focused, and paying the right price certainly helps with downside protection. Okay, so the last bit, how's it gone so far? So the returns of the fund since inception have been very strong, delivering good alpha for our clients. Again, I'd just say Antipodes is a very risk-focused manager. So you can see here the Sharpe ratio, which is the return per unit of risk, is very high, and the downside capture is very low. So in falling markets, we've been protecting capital, and I think that's about the price you pay and understanding tail risks and competitive risks that most people can't see. So the process is working well there. At an industry level, we have alpha in 10 out of 11 industries. So again, repeatability and consistency from that industry research process is allowing us to narrow down into the best opportunities, which you can do in small and mid-cap companies. And then by region, we have alpha in all 3 regions, North America, Europe, and EM. Lastly, I'd just like to point out that Zenith has given us a recommended rating. And per what you can see at the bottom there in their report, we're the best performing fund in the space since inception, and Lonsec will issue a rating shortly as well, if that's of interest to you. In terms of portfolio positioning, around 40% in the US, 30% in Europe, about a quarter of the portfolio in Asia and EM. Asia and EM is overweighted to China, and Europe and North America, we actually have a lot of global businesses, so it's probably more similar than it looks in terms of underlying business exposure. In terms of thematics, about a quarter of the portfolio is in cyclical opportunities, 20% defensive, with the rest in what we would call structural growth opportunities. Again, I would say there's a lot of defensiveness in that structural growth opportunities. I think it's been proven by the drawdown ratio, but also good growth, and so to get the combination, it's about paying the right price. So just to finish up, it's a fantastic opportunity right now in small and mid-cap equities globally. Record discounts to those larger cap companies. And in terms of this fund, it's an industry-led research approach, which is an extension of what we've been doing at Antipodes for 10 years. It benefits greatly for what we do at Antipodes, or have been doing at Antipodes over the last 10 years, and it's delivered some strong alpha in a great risk-adjusted manner since we've started. So thanks for listening to me, and reach out to your Pinnacle representative if you want to know more. Thank you.